Nau mai, hoki mai, kia ada fold, imihine, ko Duncan Greive, tōku ingoa. This is the first of 3 special episodes. I'm joined by Glen Kyne.
Kia ora, good morning, Duncan.
And what we're going to do here is something we've not done on the fold before, but it's attempting to analyse 3 different sets of results that are public in slightly different ways, because 2 of them are listed companies. One's a full year, one's a half year, and one's TVNZ, which has released some headline numbers, but not a lot of detail. But the fact that they've all come out in the last few weeks gives a sort of it really only happens sort of once or twice a year that you get the opportunity to really dig into the kind of relative performance of the 3 biggest entities in New Zealand media. But not only that, within each of them, there are these sort of challenges, opportunities, strategic realignments that are visible that have potential. It's almost inevitable that they will kind of realign some of the shape of New Zealand's media in the not too distant future. So we're going to record these today. As we record, it's Monday, March 3rd, and we will release them on consecutive days, Tuesday, Wednesday, Thursday of this week. We're going to start with NZME. Yeah, Glenn, do you want to kind of give us what your overall sense of NZME's results was? It's coming up probably 10 days ago or so.
Yeah, really credible, really solid. I think that Michael and that leadership team will be happy in the context of the market of delivering a really strong top line result. And he acknowledged the pressures, I think, particularly in the back of the year that were coming at them. But he's also done some interesting things in those results, which were perhaps a little bit unexpected. He has obviously talked about a future of One Roof looking a bit different within the portfolio, and the other thing he signalled is that the trading performance is well on track for 2025. And I raise that for no other reason, as that's a bit of a consistent theme actually from everyone talking about the fact that 24 seems to be the worst of it. 25 and looking ahead, there seems to be some green shoots and certainly a level of confidence building for the second half of the year.
Yeah, I totally agree. I was sort of pleasantly surprised by the performance. If you think about what last year looked like from above, you had Newshub exiting the market, know all too well. You had TVNZ shutting some of its most sort of beloved properties. You had NZME shutting a whole bunch of community papers. You had redundancies as a near constant everywhere. And so and NZME's financial year runs relatively rare, runs January 1 to December 31. So that this is just the whole of this is contained in that year. And for them to be essentially sort of broadly flat on a revenue basis and able to maintain their EBITDA more or less is it's very, very credible.
Well, one of the things that we've talked about before on the show is the importance of, for a New Zealand media company to diversity of revenue, not be, solely reliant on the ad revenue market anymore. And I think NZME are a really good example of running a portfolio. And that portfolio is actually the thing that has made the difference for them in this result. You look at that result of One Roof, it has absolutely pulled through the rest of the business. Different segments have different ups and downs and can be cyclical, but One Roof is clearly on a trajectory and has made a huge difference to that result.
Yeah, it's now a very meaningful contributor to its profitability, and it kind of I think for a lot of people, when they think of NZME, they think first and foremost of the Herald and maybe ZB, and then a bunch of other radio stations, and there's a lot in that business. But One Roof, as a digital property listings company that is fairly, it's not isolated from the company. I actually want to talk a little bit about the way that it is sort of threaded through the Herald in particular, but its biggest competitor is likely Trade Me.
Yes, indeed.
Versus, all the rest of the company, its biggest competitors are media, as we would understand it. And yet now it's both a significant contributor to the business, but now, and we should probably talk about it, is the biggest news to come out of it was that Michael Boggs announced that Jardins, a big local investment bank, are going to be exploring options for realising that value, which is code for, could it be, carved off and separately listed? Could it be partially listed? And the reason for that, you only have to look across the Tasman. So you've got a very similar situation there where Nine also owns Domain, which is separately listed while also being 60% owned by Nine, and has just had this company CoStar, which owns a lot of these types of businesses globally, come in quite aggressively trying to take it private and have it join their portfolio. It's just so obvious that is the ultimate preferred outcome for OneRoof, which would be, if the sort of multiples kind of are extrapolated from what's potentially going to happen with Domain, will be a pretty amazing result for NZME shareholders, and that they are the ultimate, that's who Michael Boggs works for.
Yeah, well, those shareholders ultimately get rewarded twice because they get the benefit of the OneRoof, whatever kind of strategy they decide, whether it's a listing, sub-listing, bringing capital in, either way, those shareholders are going to get rewarded for that, and then have, a very strong independent growth vehicle in OneRoof. But equally, the Herald also, the NZME also benefit at that point in time as well. So kind of a double hit. I just want to backtrack a little bit on OneRoof, because we're talking about it and it's always been in the background, but all of a sudden it's looking like a really preeminent media brand in New Zealand. And I think what NZME have done is a very credible job of building a share strategy where they have attacked their competitor largely on price. So, there was a lot of talk in the results about yield versus TradeMe. And Michael unashamedly said, we do trade price because we're building share, and we're trying to take share away from our competitor. And I'll tell you that share game can be a dangerous game to play because it'd be difficult to come back from unless it's working and getting a result for your partners that you're working with. Clearly, it is getting a result. So it appears
these for real estate agents.
Real estate agents and for the vendors, right, who are selling their homes. So clearly, it's working. And so I see them continuing to potentially take share. And as long as it is working, that does give them the opportunity to come back and address price and yield into the future. So I think it's a very, very, very credible strategy that they've employed. And I think that if you just think about where we've been in the last couple of years in the property market and where we're probably likely to be in the next couple of years, I'm no expert here, but it would seem that the headwinds are sort of behind us a little bit and the tailwinds are going to start to come in, and OneRoof's going to go from strength to strength.
And that's been a long, steady process of building, and it's always been, I think it's of all of NZME's digital properties, which include the likes of Driven, the Herald, and the various kind of radio sites, it's a beautiful digital product unto itself. It's really nicely made, performative, and it's got a whole different kind of design scheme and feel to the rest of the portfolio. There's an interesting thing, right? They've talked about having overtaken TradeMe property on UBs, unique browsers, in the last quarter. And I spoke to an Australian investor, Roger Coleman, who had some other interesting comments we might get to about this. And he's been following the Herald since sort of Wilson and Horden days, like decades. Yep. And he said at that moment when there is an overlap in UBs, that is a really signal moment in the history of these sort of property portal sites. I've always been a bit skeptical of the UBs argument, just because the way that the Herald uses the sort of traffic juggernaut that it is, its homepage, very frequently it has a lot of kind of quote unquote property porn type stories. Mm-hmm. You click through, you're not on the Herald anymore, you're on OneRoof, and therefore a Herald user suddenly becomes a OneRoof UB for that month. How much of the scale of the business is effectively borrowed traffic from the Herald versus habitual OneRoof user? I'm not sure, and they're not particularly shy. You can't pretend that that's not happening. But Coleman, said to me that they're all very aware that that's what they're doing, but it's not necessarily, it still helps build a future habit. And so it's not considered cheating, even if it's just leveraging the advantage you have.
Yeah, I mean, I'm like, if it works, it works, do it. And clearly it's got a result. I think notwithstanding what the sort of structure looks like moving forward, they'll continue to do that because it just makes so much sense. I think one of the interesting things, and why I applaud Michael and the board for taking the step at the moment, is when you're in a big business like that and you've got a segment that is growing and you want to put investment into it, it can be really hard because actually that investment can be a draw on the rest of the business, right? You kind of have winners and losers.
Well, everyone wants the money.
Everyone wants the
money.
money.
And the newsroom's like, I need to hire these people. And, and as we'll talk about in a moment, they've had to say, sorry, you can't have that because we need to put money into this thing over here, which for many years wasn't making money. So it's quite a hard thing to do. And again, it's a credit to NZME's ability to incubate businesses within it, which is really rare.
So rare in modern media companies to do that. So, absolute credit to the team. And one of the things, obviously, that will happen if this goes ahead, and depending on how it goes ahead. And I think the Domain example you talked about is a little bit instructive here. I'm familiar with when Fairfax and Domain, when Domain separated from Fairfax prior to the Nine acquisition a number of years ago, for very similar reasons. By the way, the trajectory for Domain was very similar to what we're seeing with OneRoof right now. But what inevitably happened is that you had people sitting in a building. You had a Domain team and you had a Fairfax team, both feeling a little bit disparate about one another because the Domain team was getting the money, getting the investment and growing, and the Fairfax team not so much. And so it did create a few divisions and things in the culture. I think that'll be an important thing for Mike and the NZME team to think about if they do create a economic separation. How do they create that cultural separation as well, or not, or depending on how they want to put it together? And at this stage, it's too early to say.
Yeah, so a really interesting move. But as we just mentioned, there are every investment decision you make within a business has a flow and impact. It's things that you can't do, and we've seen for quite some time within NZME this, again, quite a far-sighted belief that you can, that they were going to make a digital subscription business. And I think last results was where they announced that basically the digital subscription paid for the Herald newsroom, and that is a signal moment and a huge achievement unto itself.
Yep.
And on some level, you felt like it might signal that the newsroom was sacred and might just grow incrementally as digital subscription revenue grew. We now know that not to be true, that they lost a net 30 jobs out of the newsroom. They lost some hugely talented and important writers, the likes of Jamie Morden, Claire Trevette, but not only that, Mitch, their head of social, has been with them a long time. A lot of these people elected to take voluntary redundancy, I should say. But these are like massive talents within the NZME ecosystem, and they have a belief that they can live without this. But that is this for a subscription business where the consumer is paying to access the journalism of these people, largely the written journalism. Even though they lost a lot of production jobs, it's hard to see how that doesn't make the product worse.
If we extend out from that point, one of the interesting things to think about is what does NZME look like without OneRoof being inside that result? And it's a bit crass to do this, of course, because we don't know exactly how it would be structured. But Forsyth Barr has suggested that half the company's value is sitting in OneRoof, right? That's huge.
It's so huge, and there's a couple of points about it. One is the company effectively halves in value, and it also has that kind of uncomfortable thing of it sort of makes that there's this kind of shiny technology company that's going to sail off into the future, and it makes the publishing side, the radio, the media side of the business look a bit less sexy. But there's this other thing, which is if it's that makes it, I think, it's sort of sub $100 million business on current market cap. That makes it a lot more vulnerable to takeover. It's just a cheaper asset to buy, which still has all of the kind of reach and impact and power. And there was an interesting development that I think was just reported this morning as we record this on Business Desk that, and I'll just read from it, Canadian private equity tycoon James Greive has taken a 9.3% stake in NZME for, quote, investment purposes. Now, I've no doubt that this is an investment for him, but if you look at Business Desk has also previously reported that Greive has previously had New Zealand media interest in the form of the Centrist, which is a really interesting sort of digital property. It's largely a news aggregator, but it's got particular interests in, I guess you'd call it, quote unquote, woke issues, but also like a sideline in vaccine injuries and vaccine skepticism. It's you can do a lot worse with that kind of bundle of things. It's relatively soberly run in some respects, even though it has these preoccupations, but it certainly suggests a very particular worldview. And there was an interesting slide in the NZME earnings presentation that essentially was a statement of editorial values that was quite, you wouldn't normally put into a presentation like that. And it just, your sort of spidey sense goes off. It's like, is there and there had been previously reports, which Mowbray himself has denied, that Nick Mowbray was looking at taking it private. There's just a feeling that a subdued value and potentially a future state of NZME that is a smaller company becomes then vulnerable to take over in a bit of an editorial realignment on that basis.
Yeah, one of the scenarios I thought through, and I think was it 10% that the new shareholder
just shy of
10%, which is a significant number.
Very.
And interesting to see where that number goes and heads, by the way. But a theory in my head was I wonder whether OneRoof actually becomes the listed company and actually NZME does privatise.
Totally.
Is this a signal towards that happening in the legacy business? Not that I should be calling NZME a legacy business, but
the traditional part of the business.
Traditional part of the business. I think could do with the help of running that as a private operation, right?
Yeah, it's interesting, right? So this is all, we should stress, conjecture at this point. It might well be that he just sees an asset at a reasonable price with various forms of upside, but there's just a sense out there that something could happen, and certainly the OneRoof situation on some level makes it cheaper and easier in various different ways to execute that. Now, the other thing about the redundancies, the flip side of that is that was done not just to rip out costs, it was actually done to invest in a new venture, which you know quite a lot about and might be able to speak to. So just finally on the redundancies before we get to that, I've spoken to a number of people who were in the Herald newsroom, and these processes are never good, but they described it as the sort of Hunger Games of journalism. You actually hear that from other organisations too. But one thing which was particularly galling to them was coming out of their meetings where they sort of learned what was happening to them as sort of individuals or as teams. And the first way that they found out the full scope of it was, credit to them in a way, but was Shane Curry's reporting on their own website. So this does impact on people, and you saw the subscription business revenues up 10%, but with a 16% increase in subscribers. So they're really having to work very hard and lowering their average revenue per subscriber to achieve that. But ultimately, this is in favour of swinging from subscription revenues to advertising revenues through a fast channel. Do you want to just top line that, because you'll be quite familiar with it, I would think.
I am, yeah. Well, advertising and sponsorship. So a fast channel, for those that aren't aware, it's in the digital video domain. It stands for free ad-supported television. And it is gaining momentum around the world. And the reason it's gaining momentum is paid streaming, so SVOD services, are considered to have hit a bit of a market ceiling in terms of the propensity for people to get their credit card out and pay for content. Still incremental and still growing, but at a much lower rate. Whereas fast being free creates broad access to people and obviously uses just advertising to support itself. So looks a little bit like, I guess, a broadcast channel in a video sense. But a lot more dynamic than that, and certainly run a lot more cost effectively without the necessity for broadcast infrastructure. So what's really interesting about the Herald, and we'll come back to the details of what they're doing at the moment, but if you just think about the video news marketplace right now, you had Stuff do the deal to obviously produce 3 News, and no doubt happy about that, but have not signalled yet that they're going to move into a fast channel and are using that content in interesting ways. I wouldn't say volume-based engagement ways yet on stuff.co.nz. You've got TVNZ who have signalled that they have to create a digital home of news on TVNZ Plus. I suspect a fast channel was probably in the mix in there somewhere.
It's quite telling that the first announced fast channel for news in New Zealand comes from a print publisher and not from the biggest video newsroom in the country, or even like RNZ. Like there are so many people who would, if you were just, helicopter view looking down and going, who's best placed to execute this? And again, on some level, like first to announce, they haven't launched it yet and there'll be trials along the way, but it does sort of point to the sort of posture and nimbleness of NZME that they've said, we're going to do this ahead of people who would look better qualified.
Yeah, so interesting battleground, right? If you potentially have 3 players with similar strategies. But what the Herald have done, first of all, Ryan Bridge, brilliant broadcaster, has huge appeal to a very broad audience. So great shout to create that as the anchor show. You've got Sarah and a gentleman called Darren Fui in there, so absolutely know how to put this type of content together.
The former News Hub
people. Yeah, Sarah head of news, and Daz used to run operations for the newsroom. So, you've got people that know what they're doing in the space. There's a few things, though, that are going to be absolutely critically important for them to make this work. One, you can't think about the monetization of this as a digital video player. You've got to think about it a bit like a broadcaster. You want to be able to get the highest price CPMs, the maximum amount of sponsorship dollars out of the market that you can. And so to do that, you need the broadest distribution possible. So having it sit on just the Herald alone, I don't think would be enough to get the distribution and reach they need. I think they will need a broadcast partner to simulcast that show. I suspect they're in talks to do that. And they will possibly need other distribution points as well, like YouTube and others, to just absolutely extend that reach. That will allow them to then do what Michael's aspiration was to start to get, many multiples of their current digital video revenue streams in the door.
Yeah, he used that phrase. He said that it's single-digit millions at the moment that they get, and they want many multiples of that. I mean, that's whatever that is, it's a big number.
Well, if they don't get the distribution strategy right, that won't happen. So, distribution is key. Content strategy is key. So they've started with this show. They will build out of that. So I've no doubt you would see markets with Madison. You would see podcasts. I'll let you talk about a particular point coming in a second of another piece of content, but they need to build that out pretty quickly, and they also need to invite partners in to create brand-funded content that can sit in that stream. And my final point for success for them is they're going to need to really think about their pricing strategy. If you undervalue yourself in this market, particularly in a broadcast type environment, it's very difficult to rise prices into the future and get those gains that you want. So they have to think with the end in mind and price themselves accordingly.
Yeah, so with fast channels, the way that they operate is not like a conventional linear channel where there is, there's a sequence to programming and news content will typically go out sort of live. What they'll do is essentially have a rolling suite of content that kind of gets swapped in and out as new things are created. And there will be sort of anchor shows, potentially even at 6 p.m. There'll be a top of the hour. But what they've signaled... Breaking news, which is a really there is no place for that
Yep.
now. I mean, if it's big enough, it'll break into schedule on the likes of One News, but the bar can be set a lot lower for going live with a channel like this. So I do think it's an interesting piece for the market. But one of the things they've talked about is taking things like their front page podcast, but also in a sort of a sales piece that you obtained. They've mentioned that Media Insider will be a podcast and a vodcast. I mean, Shane's getting bloody busy. He's got the highest output of any journalist in the country, I reckon, and they're asking more of him. But, that kind of thing would be really interesting, compelling stuff. And this is without even, they don't really talk about it yet, but it just seems like an absolute no-brainer to have a stream of Hosking, or at least make use of that talent. It might well be because it's outside of his current contract. I don't know, but they've got the whole ZB infrastructure off to the side there. There's just a lot of stuff that once they can figure out a way to package it, that it can work. The one thing I want to talk about probably before we move on to the next the next episode is all of this is predicated on it's advertising. It's purely ad funded. It's free, ad supported television, and it's interesting, right? There was a number in their and reference made in the earnings call to agency costs going up. I think that they've had a very good part of their result was driven by pushing really hard into media agencies. And you had a sort of an idea about what might be the sort of, but their costs were up sort of 9%, I think. There, you had an idea about why that might be, why the costs might have gone up. The cost of getting that money in is higher.
Yeah, I was surprised because to make a channel shift that quickly is unusual. And to see the cost go up, you would expect to see a really significant bounce, I would have thought, in revenue. But that didn't appear. And so if you just think about the dynamics of that, you would expect direct to be far lower, the agency revenues to be a lot higher. And that doesn't just happen at the. So I was just wondering whether or not there was, some sort of principal media deal that may have been done in the background to accelerate spend, which is a perfectly legitimate thing to do. But that may have helped them get through that half.
Yeah, they made reference to that Auckland was really soft, South Island was okay, that direct was quite soft. So the continuing kind of low business confidence, moribund economy, particularly felt through the sort of SME type businesses that typically drive radio sales. So just an interesting thing to keep an eye on. The big broad thing about this whole set of results that I think is interesting is that for the last 5 years, the story of NZME has been about the growth of digital subscription revenue, and that's particularly the Herald.co.nz premium product. And that this time around, it felt like advertising and One Roof was much higher in the mix. And I wonder, and even they made reference to digital is now 31% of ad revenue, but of the Herald's digital revenue, that free users are 59%, i.e. advertising, is more than half of their digital revenues. And you understand that from a product perspective. When you go there, you get the pop-ups, you get the homepage takeovers. Even when you're a logged-in premium user, you are absolutely drowned in advertising. Whereas if you go to I think the market leader here, New York Times, there's a far lower ad load. You can feel the fact that this is all about, the whole of the business is geared around increasing their subscription revenue. Now, the most recent numbers for the New York Times, for the quarter, subscription revenue was $466 million and advertising revenue was $165 million. So almost actually, it's the inverse, but it's even more so. And so the Herald appears to be picking advertising over subscription. Now, I'm sure that's not a total, like that's a gross oversimplification, and the likes of Business Desk, and they will have a plan to grow it. But you can just feel that NZME is fundamentally a sales operation with a whole bunch of things stacked around it. And even in a world where digital subs are the sort of holy grail, they're still doing very well out of digital advertising to the point where it doesn't feel like it's the center of any part of the business, including the Herald. That's how it looks in the results.
I think what you're describing is the dilemma of operating a media company in a subscale market like New Zealand. When you look at the Times, that makes so much sense to me because the scale of subscribers that they can appeal to around the world. The Herald can't do that. They're, very much geography bound to New Zealand. And I think that, so they have to be able to turn on that advertising tap as hard as they possibly can, to make it all work. And they're doing that to their credit.
Do they have to?
I think they have to at the moment, and I think the second point is that until that subscription base can grow, but they've got to figure out how to grow it beyond incremental win-back activity or trying to appeal with an offer to bring in. I think what they need to do is figure out what segments do they want to go to that are not talked to, where people are prepared to pay. And I think they've done a little bit of, different model, but they've done a little bit of that with the listener. They've done a little bit of that with Business Desk, Viva, of course. What are the other segments that are going to encourage people to get their credit card out?
Yeah, or even, you look at the big play in television is to have a sort of an entry-level subscription tier that's ad-supported that actually ultimately drives more revenue because you can, put a bunch of advertising against someone who's already paying and they save some money on their Netflix sub or the Disney Plus sub. I wonder if there's a version of that for the Herald where you can pay some quite significant premium, you get all of the products and you get them sort of very either ad-free or very ad-light. Maybe that would be a solve, because I've got to say, as a Herald Premium subscriber, the fact that I get the same user experience, even on their best journalism, as a sort of a non-paying freeloader, to my mind, it irks me. And if I had a good alternative, I can imagine being vulnerable in that situation.
Yeah, I think you're not unique. I think there'll be lots of people that would share that sentiment. But I think a lot of New Zealanders out there are not going to pay. A lot of New Zealanders are not going to pay more. And don't necessarily they've got there's got to be a value construct that sits behind that enables that. One of the ways they can do that, by the way, that a lot of the and we will talk about this a little bit later with Sky, but one of the ways they can do that is to think about bundles. What bundles can they put together, potentially even outside of their own content, right? Can they bring other partners in, bundle that up together, put that in a subscription?
New York Times are experimenting with that right now.
Yeah, that works. That's shown to be working around the world right now. So I guess watch this space, but I honestly don't think they have a choice but to keep that tap turned on as aggressively as possible right now.
All right. Well, I think that concludes NZME. So much interesting stuff in there, and so much to come. Right? Like, we don't know what I'd be shocked if the outcome of this Jardins survey wasn't to kind of carry forth. You don't really commission it unless you have a pretty good idea of the result that you want. But the new shareholders, the fast channel. There's just going to be a lot of action here. NZME is really working right now, and be very exciting to look at. We'll now end this and jump into TVNZ coming out tomorrow.
Mm-hmm.